The tri-star candlestick pattern is a rare three-candle pattern that signals a potential reversal in the market. It is composed of three doji candles, which have very small or non-existent real bodies. The first doji represents a period of indecision, while the second doji represents a continuation of the indecision. The third doji shows that the market has reached a point of equilibrium, and a reversal may be imminent. The tri-star pattern is a strong indication that the market may be changing direction. Traders look for confirmation through other technical analysis indicators such as support and resistance levels, trend lines, and volume. The bullish three stars in the south pattern is a popular technical analysis pattern used by traders to identify potential bullish reversals in the market. This pattern is formed by three candlesticks, with the first being a long bearish candle, followed by two small bullish candles that gap down from the previous candle. Traders look for this pattern at the end of a downtrend, as it indicates that buyers are entering the market and pushing prices higher. While the two small bullish candlesticks suggest that buying pressure may not be very strong, they are enough to reverse the downtrend. The bullish three stars in the south pattern can be a valuable tool in a trader's arsenal for identifying potential bullish reversals in the market. The unique three-river candlestick pattern is a reliable bullish reversal pattern in forex trading. This pattern is formed by a series of three consecutive candlesticks with lower lows and lower highs, followed by a fourth candlestick with a higher close. This pattern indicates a shift in market sentiment from bearish to bullish as buyers enter the market and push the price up. During the first three candlesticks of the pattern, bears are in control of the market, pushing the price down with each session. However, during the fourth candlestick, bulls take control and push the price up, breaking through the resistance level formed by the previous candlesticks. With proper analysis and risk management techniques, the unique three-river candlestick pattern can be a valuable tool for forex traders. A hammer candlestick pattern is formed when the price opens higher than it closes, but then reverses and closes higher than the open. This pattern is seen as a bullish signal, indicating that buyers have stepped in to push the price higher. A shooting star candlestick pattern, on the other hand, is formed when the price opens higher than it closes, but then falls and closes lower than the open. This pattern is seen as a bearish signal, indicating that sellers have taken control and pushed the price lower.